SPH REIT released their first half FY22 financial results on 1st April. Is it a good time to collect their shares now? My view is no, as there are no margin of safety at the current price of 97 cents. Let's see why. As always, this is not investment advice. The portfolio of SPH REIT comprises 5 commercial properties in Singapore and Australia. They are Paragon, Clementi Mall, and the Rail Mall in Singapore, and 85% of Fig Tree Grove and 50% of Westfield Marion Shopping Centre in Australia. Let's start by looking at the key highlights of the first half FY22 financial results. SPH REIT highlighted that their gross revenue, net property income, and DPU all increased year over year. They also have high occupancy rate, healthy portfolio weighted average lease expiry, and disciplined capital management. Something to note here is that net property income growth was partially dampened by increase in electricity rates. The increase in electricity rates will affect all retail and office REITs. The assets in Singapore and Australia are still affected by COVID-19 cases. To manage the rising electricity rates, they are exploring initiatives to manage the costs. This table shows the comparison between first half of financial year 2022 and first half of financial year 2021. The important information to shareholders is that the DPU increased by 9.8%. The quarterly DPU from first quarter of FY21 to second quarter of FY22 is relatively flat, between 1.2 cents to 1.58 cents. If you look at the DPU before COVID-19, it is on an uptrend from 2014 to 2019. Looking at the DPU in FY 2021, there are signs that the DPU is on track to recover to pre-COVID levels. Do subscribe, like and turn on the notifications if you enjoy the content. Thank you. SPH REIT have a resilient balance sheet with net asset value per unit increased by 1.1%. With the interest rates set to rise further, SPH REIT has a disciplined capital management approach in place. They have a low gearing ratio of 30.1%, low average cost of debt of 1.66%, and a high interest coverage ratio of 7.7 times. It will be better if their cost of debts are tied to more than 73% fixed rates. Something to take note here is that 33.5% of their debts are maturing by 2023, and they didn't mention on how they are going about to refinance the debts. I will be concerned about this if I'm a shareholder, as the refinance cost might be much higher than current rate due to the rising interest rates. SPH REIT has a good portfolio occupancy of 98.4%, with a weighted average lease expiry of 2.8 years by gross rental income. They have only 6% of leases expiring this financial year. In my opinion, I don't see much issues in SPH REIT getting their leases renewed, as more countries are opening up and relaxing their COVID-19 measures. SPH REIT have various strategies to ensure growth. Most of them are motherhood statements. Hence, I will not be going through them. I would like to bring your attention to SPH REIT having the rights of first refusal of the Seletar Mall and Woodleigh Mall. In my opinion, Seletar Mall will be a great addition to the REIT, as I go there frequently and the retail businesses are doing great. The 5 parameters of SPH REIT are shown. 3 out of 5 parameters met my personal preference. In my opinion, this REIT is not attractive at the moment. As mentioned, the cost of debt is low at 1.66% currently, which is great in a rising interest rate environment. Next, we will go into the technical analysis of SPH REIT. We are looking at the weekly candles chart here. The share price is on an uptrend since the COVID-19 crash and is sideways since IPO, as shown by the blue box. The share price is about to hit the horizontal resistance of 99 cents. With Singapore and Australia further relaxing their COVID-19 rules, it looks good for SPH REIT at the moment. There might be some price consolidation at the horizontal resistance before breaking out to newer heights to continue the uptrend. Together with the earlier fundamental analysis, I will not be looking to buy at the price now as it's not heavily discounted. SPH REIT is a fundamentally strong REIT, but the share price is not discounted right now. As my aim is always to buy fundamentally strong REITs at a good price, the price I will be looking to enter is about 82 cents, where it represents a discount of more than 10% to the NAV. In terms of technical analysis, the share price bounces off the 82 cents support 3 times and thus represents a strong support zone. The yield we are looking at if we are able to collect at 82 cents is about 6.88%. Another reason on why I am not looking to collect SPH REIT at the moment is because in my opinion, Lendlease Global Commercial REIT offers better value at the current price. Do check out my earlier video on Lendlease Global Commercial REIT if you have not watched the video. To summarize, what I like, dislike, and things to take note about SPH REIT is shown below. Please pause the video here if you want to take some time to recap. This is a list of references I have used to create this video. Do subscribe and check out my other videos. Have a great day ahead.